Welcome everybody to Greystone's Market and Economic Outlook. We're pleased to have you here. It's so nice to see people in person and be able to meet like this. It's been a long couple years, so we really do appreciate it. We appreciate everything you do for us. We appreciate the relationships. I'm joined with my partner, Kristie Guadiano, and we're really gonna just jump right into it. She's gonna introduce the colleagues of Greystone, and then we're gonna start our panel discussion and hopefully give you some information that's helpful and to make you feel a little bit better about today. That's perfect timing. I know, thank you. So what we're gonna do a little bit of a round table here. I'm gonna moderate, and we're gonna try to give you the breadth and depth of what the investment team does, how we make our decisions, how we do things, and what we're looking for. So I'm going to start with a question to Bobby. How would you describe Greystone's investment management philosophy?
Yeah, so at Greystone, we use a tactical approach. And by that, I mean that although we have a baseline mix of assets suitable for different or multiple risk tolerances and investment objectives, we will adjust portfolio weightings to limit downside exposure and generate higher risk-adjusted returns.
Yep. Can you describe the general decision-making process that goes into choosing the investments that we want to hold on any given day?
Yeah, so we use a combination of different methods to effectively manage our investment strategies. Try to give like a broad overview of our process. Really starts with a top-down approach. We start by determining the overall health or status of the global economy to figure out where it's headed. And from there, based on that information, we can target specific regions or sectors of the market that we think will outperform in the current market conditions. Then if we dig a little deeper, we can go on the industry level and target ones that we think will give us the best chance of success. And then really at this point, we start focusing on finding the best company or companies within those industries that we think will be our best investment choices. We try to learn as much as we can about the companies, and we use fundamental analysis to basically better understand the overall health of the company. This research stage of the process probably consumes about like 95% of our time. It's critical, especially right now, to succeed in stock picking if we're going to perform well. The days of fairly easy market returns the last couple of years are done. And we believe it's the time and effort that we put into our research that is ultimately going to lead us to make solid investment decisions more often than not.
You know, topics like inflation and higher interest rates and the Russian invasion are on everybody's mind, or many people's minds, and they it creates worry and disruption in people. Can you give us some specific ideas of how we handle it and how we try to attack it, how we try to navigate what we're trying to accomplish?
Sure. Going back to last year, it became apparent that the Fed was going to need to raise interest rate to combat the inflation we were seeing, and that wasn't necessarily a bad thing. It just meant the economy has recovered enough from the impacts of COVID-19, so it can handle rising interest rate. So, given that, we started to make a rotation favoring more value stocks over growth stocks, because as we've seen in the last year, growth stocks have come down fast and hard, crashing. And our approach was based on, because value stocks tend to do better during a rising interest rate compared to growth stocks. So making that tactical adjustment has allowed us to cushion our clients' portfolios and minimize the damage that could have been done otherwise by the current market sell-off.
When clients wonder where the market's going from here, and how Greystone's navigating it, what would you tell them?
Yeah, now I know why you asked that question. So I'm a real big believer in not predicting. You know, you turn the TV on and everybody's predicting this and this is going to happen, and I tell you, it hardly ever happens like that. The minute somebody all thinks something's going to happen, it doesn't. And so we do not predict the market. Are we studying it all day long? Yes, these guys have 4 computer screens, they're in it, and we see things and it's real time, but we react, we don't predict. So we let the market give us what it will and we take advantage of it. But we don't try to make a really right bet, because really, with that strategy, making a really right bet, you can also get a really wrong bet, and that can wipe you out.
Okay, so as Todd said, I'm his partner. The one side of the business that I run is the corporate side. So I handle all of the 401ks, the retirement plans, the pensions. And I'm sure all of you have heard about the Secure Act, which came in 2019. It was the first real legislation that focused solely on retirement planning and retirement savings for employees, individuals, and employers. So we just refer to it as the Secure Act. It's a really long acronym for something that most of you don't care about. But there's a new one on the table now called Secure Act 2.0, which is expected to be on Biden's desk within the next few weeks. And it affects everyone in this room, if you're an employer, an employee, or a retiree. So I'm going to go through the top few pieces of it that you can expect to take into effect within the next few years, some starting as early as this year, that will affect some of your planning that you'll do with your directors and your contacts here when you're looking for the future. So the first thing is catch-up contributions. When you're an active employee or you're an employer, in 2022, you're allowed to defer your own money right into your company 401k plan, $20,500, right? They have a rule called the catch-up provision for the year that you turn 50, you're allowed to do what's called a catch-up contribution. So currently it's $6,500. Starting in 2024, when you hit that catch-up phase, you can do $10,000. So it allows your taxable deferral, tax-deferred growth to continue, substantially larger than they have. Normally the catch-up, they raise like $500 roughly every other year. But starting in 2024, it'll raise to an additional $10,000 over what the traditional deferral limit is. For both employers and employees to consider. Also attached to that catch-up contribution piece, all of your employer contributions right now are pre-taxed, whether you choose to do post or pre-tax at all. You're going to be allowed the decision if any company money coming into your account is going to be pre-taxed or post-tax. They've never done that before. Everything currently that your employer puts in for you right now is pre-tax deductions, because they take the deduction out on the business side and they give it to you, and then you pay tax later. You're going to be able to decide how you want to pay tax on that going forward. It will be individualized, so it's an important thing to kind of talk through when you're looking at your contributions and your financial planning, on an individual basis. This whole Secure Act and then Secure Act 2.0, it's really driven solely on retirement planning, as you can tell, right? Every topic has come to how to help people save and defer and use your employer and things like that. Employers are not necessarily going to love this change because it gets people in their plans that require them more money quicker or at some point more than they ever would. For part-time employees, it gives you the option to defer some of your part-time pay into a 401k plan with your employer. And after that, your employer technically cannot say no.
As mentioned before, my name is Eric Babcock and I'm a director here at Greystone. My primary role as a director is I work with the clients on their financial planning and working through the strategies we need to make that financial plan work. So when I work with a client on the financial plan, it's you, the client, me, the director. What we want to do is establish what are your financial resources today, what are your planning goals, what are your financial goals, what steps can we take to achieve those goals, and what risks exist that we need to mitigate to make that plan work. Now, the thing is, there's a lot of it we do here at Greystone, but there are also partners we need who don't work with Greystone but are part of your life that we want to work with. Probably the one external professional we're going to work with the most is your CPA. Our goal is to be tax efficient. That said, to be very clear, I hope you all have a huge tax bill every year because our portfolio team did such a great job. But what we don't want is for you to be paying unnecessary taxes because we could have made a couple of moves here or there. Our next speaker is Kathy Walker. She's one of several CPAs we do a lot of work with. Some of you in this room may work with her already.
Another offer you strategy we heard about earlier too, contributing to pre-tax retirement plans, such as the employer 401k plans, 403b plans, or traditional IRA if eligible. Of course, the benefit of contributing to a pre-tax account is the fact that you don't pay tax on the money now, but all the distributions are taxable at retirement, both the contributions as well as the earnings. That works well if you're going to be in a lower tax bracket when you retire. But who in this room knows what tax rates are going to be like when you retire? I don't know. So instead of having all your eggs in one basket, that pre-tax basket, it may be wise to consider putting some funds into an after-tax account, such as a Roth IRA. A Roth is funded with those after-tax dollars, which grows tax-free. When those funds are withdrawn in retirement, none of it is taxable. Of course, I will caution you, there are limitations on how much you can contribute to a Roth, so you do need to talk to your advisors about whether that's even a possibility for you.
RJ is going to give us a little update on economics and business and what's happening in Metro Detroit.
On the automotive side, obviously we've seen this shift to electric vehicles. They are still not ready for prime time. Everyone here visits service stations from time to time. Not a lot of electric chargers there, and they're not very quick. There's range anxiety. Now they've gotten into the problems of supply chain delays. You have child labor that's sourcing some of the lithium ion and other materials out of Africa. And you're now seeing some of the automakers going back and exploring hydrogen as another clean alternative. The autonomous vehicles, those are also going to be a bit slow to roll out. They have all kinds of problems. You've probably read some of the stories about Tesla, and even they admit that's not ready for prime time. Those autonomous vehicles, you'll see that occur in the trucking industry first before it comes into the consumer market, and it'll be very short, dedicated routes. On the aerospace side, you'll see the same thing, and I think aerospace, as it relates to autonomous features, will be a little quicker because there's just not as many things in the air to deal with as there are on the ground.